Traders, this is Cousin Vinny coming to you from theclosingprint.com on May the 20th, 2018. In this edition of your weekend video newsletter, we'll talk about the indices, all of which moved lower with the exception of small caps. IWM was up 1.27%. Most indicators are mixed but slightly bullish as the markets moved sideways and consolidated recent gains. The 10-year continues to show strength and the possibility that yields will break their downtrend and continue higher. Institutional sentiment is mostly bullish, with the Nasdaq more bullish than the NYSE at the present time. NYHL is mostly bullish. The cycle is up, and we have the NYAD bullish as well. The put-call ratio is neutral. VIX is moving lower, showing that fear is dissipating. All of this with the backdrop of the US dollar moving higher. Yen is moving lower in a bearish trend, with the Nikkei moving in the opposite direction as you would expect. The British pound US dollar pair has moved lower, which is bullish for the London Stock Exchange and the FTSE. We did see a short-term fade on yields last week on Friday, with TLT and bonds showing a potential double bottom for the current week. We have the CRB index flat, gold is lower and bearish, and copper is sideways. Crude, of course, continues its bullish trend above $70 a barrel, and uranium is sideways. We have the heat map, most importantly, moving towards yellows and greens, adding a few more greens, which was a little unusual. Didn't expect that. But we do have strength continuing in oil and gas and equipment stocks. Healthcare, consumer discretionary is in caps for a reason, as that's one of the top 5 groups in the IBD 197 industry groups that are at the top of the list. International markets are being affected by the higher dollar and higher interest rates. We'll look at these IBD 50 names in addition to some MarketSmith potential trades. And we have Bulkowski with 4 or 5 green with a CPI signal since April the 3rd at 73.7, which is bullish, with 10 bearish patterns, 28 bullish patterns, and 403 patterns waiting for breakout going into this week. Starting off this week, let's take a look at the sectors, which you can see have built more yellows and greens than the preceding 3 weeks, red from left to right. We can also see that the Russell 2000 small caps are outperforming the other indices, with strength persisting in tech, even though big cap tech stocks did pull back a bit, taking a breather. Therefore, if we look at the weekly chart of the spiders, we can see price action has held at the 20-period moving average. Buyers did step in, so we're looking for a push off of this level to continue this thrust higher. RSI is above 50, and we have oscillators starting to turn and bottom. Volume was lower on the recent move sideways. To start this week, we should see a potential test of the highs. If not, we could see a move back down to the 50-period moving average, which is what we talked about last week. During this 8-day move higher, we didn't fail, but moved sideways, whereas the previous 6 occasions, each time we hit a pivot high, we immediately failed and moved dramatically lower. 1, 2, 3, 4, 5, 6. So as RSI continues to point to relative strength, staying above the 50 zone, we should see price action drift higher. Now, tick cumulative for the most part is moving sideways, consolidating, but the moving average continues to drift higher. So that's bullish for this stock market in the short term. And of course, the other thing to consider is the sideways price action. Very clear on a Renko chart is building white bricks, but is still in this sideways consolidation. As you can see, the moving average is sideways, much like it was back in 2015. So in the worst case scenario, we could come back down and test the lower part of this range. Best case scenario is we start to move higher and test 277. I think that's most likely the scenario, given some things we'll cover in this week's video newsletter. We see a similar picture on the Dow Jones Composite. This is 65 stocks in the Industrials, Transports, and Utilities group. This most closely reflects Dow theory. That said, we're above the moving averages. We are right inside this volume by price band. Most likely we'll push higher and take out these pivot highs. As more stocks are breaking out and fewer are failing, a market change in character from what we've seen previously, like we just discussed with these pivot highs failing immediately. We can see this strength also in the Dow Jones. Now this is only 30 stocks, something that CNBC doesn't usually point out, but we are in this volume by price band. Looks like support. The 50-period moving average is flattening out. Price is above. RSI is above 50. And we have MACD above its signal line, with stochastics nearing the oversold zone. We're looking for the Dow Jones to continue higher as well. This is a chart of the NASDAQ 100 A-Rune indicator. And while the big cap tech stocks were consolidating last week and did move a bit lower, A-Rune is bullish. The green indicator is above 70, and A-Rune down is pushing back down, rejected at 50. So that indicator, if it continues to move lower, would signal a potential test of the March pivot high. The NASDAQ Composite 60-minute chart has been moving sideways. It needs to get back above the moving averages and take out this pivot high if you're bullish, with RSI moving higher. The good thing is that tick cumulative for the NASDAQ has continued higher, which is telling you they have been buying more stocks on the uptick than selling on the downtick, with software leading the group. So look for this to continue higher if you're bullish and a failure if you are bearish. The New York Stock Exchange, new highs, new lows, continues to build a histogram bar above zero line, as we can see, with price action moving sideways. The upper half of its Bollinger Bands, which are starting to turn in somewhat, looks like the upper band is moving higher, lower band is turning, so that could signal, if it starts to parallel the upper band, could signal a grind higher. We do have the New York Stock Exchange advanced decline moving higher, which is more bullish than bearish in the short term. So look for this indicator to continue to point to a bullish picture rather than a bearish picture in the weeks ahead, unless this changes dramatically. The NYSE Composite is also consolidating along this volume by price band. A push above the moving averages would signal a continuation of the 8-day preceding trend prior to this flag. Stochastic is embedded, and more importantly, the high-low percent is moving higher, which is telling you 52-week highs are outnumbering 52-week lows as this rises and expands as it moves above the 50 level. Looking for higher prices when this indicator is pointing to the upside. Now we won't reach extremes until we hit the 80 to 90 level, so there's plenty of room to the upside if this indicator and price action continues to climb. A more likely scenario, in my opinion, in the short term, especially if we continue to see strength in industry groups and rotation. In addition, if we consult the Wilshire 5000, a broad measure of market participation, we do have oscillators moving higher above their signal lines. On balance volume continues to climb, and most importantly, Chaikin money flow, a measure of buying by institutions, is above zero and continues to climb. We can see on previous occasions where we moved higher, Chaikin money flow was also green and above the zero line. So watch these indicators and look for the Wilshire and the IWM to continue to paint a bullish picture, as both indices are pointing to a potential breakout during the summer months, with IWM outperforming last week up 1.27%, as we talked about in the opening monologue. All the other indices took a breather. We have small caps leading at the present time, as we can see in this weekly chart, breaking above the 160.25 zone, an ascending triangle breakout, which is a continuation pattern, with RSI pointing to further upside as a potential scenario. And finally, not to sound too overly bullish, we want to look at the XII. This is what institutions are positioned, with 75 stocks most commonly held in their core portfolios. We did close inside of standard deviation 1 Bollinger Bands, as we can see, which would be a stop if you're long the markets. These 75 stocks, as we can see, the oscillators are moving lower and flattening out in some cases. Still more bullish than bearish, but you have to be aware of the fact that this could pull back to the 20 SMA or this previous breakout level just slightly lower as we set up for the summer months. So just keep that in mind going forward, as more directional information provides itself this week. As a backdrop to everything we'll talk about in this video as well as this week live, this is not my opinion, it's just where it resides related to a trend line that goes back decades. So with RSI overbought and oscillators pointing to potential further upside, we could see a little bit more before we come back in. Now Friday, the 10-year did come back in a little bit, but not enough to break this current uptrend. So watch 10-year yields this week. They are definitely going to have an impact on our longer term portfolios, but we need to reassess the current conditions as they continue to trade near 52-week highs. We did touch 312 last week, I believe. That said, there are a lot of cross currents that need to be considered. If you are a baby boomer that's in retirement, you have to consider where your investments are positions. If you're fixed income, you're not getting much bang for your buck trading bonds. So the alternative is currencies and the equity markets. International markets don't look as good as the US markets, so that's something that fixed income investors need to look at for their longer term portfolios. Since bonds will move opposite of yields, obviously, we're looking for this double bottom to catch hold and maybe come back to the moving averages, the 50 period in this case overhead, as TLT starts to bounce, which would lead us to believe that yields will move lower. So there's a lot of moving parts in the macro issue, and assuming some catalysts might present themselves, thank you to Corey for this update, where China supposedly agrees to buy at least 200 billion more in U.S. services and goods to ease the trade dispute between China and the U.S. So that's more good news for the Trump administration, and it's actually good for the Chinese economy as well. So look for these two news items to continue to unfold this week, which would be a bullish catalyst for equities going forward in the short term. One less news catalyst to weigh the markets down as we move sideways over the last week. With the US dollar moving higher, this will create more headwinds for international companies that do business overseas as the US dollar continues to move higher. We do have some areas where we might see some rejection or inflection points overhead at 94 and 95. So that's something to consider as well. We're fairly extended, but this is very bullish looking at the moment. With MACD above its signal line, we are witnessing lower highs on the histogram as we saw some profit taking a week ago. This did thrust higher, so look for the dollar to continue to show strength. If you're bearish U.S. equities, if you're bullish U.S. equities, you want the dollar to come back down and at a minimum test the 200 period moving average that we passed through 3 weeks ago. So with the same mindset, a lower dollar would benefit U.S. companies and the economy, whereas the yen continues to move lower. We've seen the Nikkei moving higher. And with double Bollinger Band strategy continuing to point to further downside, we might not see an inflection point until we get back down here to these December, January lows. So keep that mindset going forward as the Nikkei moves higher with the yen moving lower. Inside of the channel, sweet spot between standard deviation 1 and standard deviation 2, we broke above pivots. If you are an investor looking for other areas to invest, look no further than the Nikkei, which looks pretty bullish and most likely will continue to move higher if the yen continues to move lower. The same can be said for the British pound US dollar pair, which has been in a downtrend moving lower just inside of standard deviation 1, rejection at the 200 period moving average. Looking for this to move lower. We got a lot of wicks down below, a lot of wicks overhead over the last 2 weeks. So if this does start to move lower, we would expect to see the London Stock Exchange and the FTSE moving higher in response to a weaker pound. As we can see with the London Stock Exchange, also in the sweet spot between standard deviation 1 and 2, following through to the upside. So if you're looking for alternate investments and areas to put money to work, look to the London Stock Exchange, the UK, or the Nikkei, with the Japanese yen and the pound both moving lower. Dollar-denominated assets in the commodity space like copper have been moving sideways. With the dollar higher, I would have expected copper to be dramatically lower. It is holding its own, so that's a good thing. While gold is reflecting more of the correlation between a higher dollar, it has been moving lower. It's below its 200 period moving average, below volume by price bands. It's in a reverse Kirby. We do see something of a bear flag with wicks on top and bottom. So indecision at this point at the 1290 level. If the dollar does continue higher, expect to see gold continue its trend lower. If the dollar reverses, look for a retest of the 200 period in the short term. And of course, West Texas Intermediate crude along with Brent, both moving higher, continuing this bullish trend since we've broken out in 2017. We continue higher this year, driven mostly by Middle East tensions. As a result, a lot of the small cap names in the oil and gas group are exacerbating the move in the Russell 2000. So if crude continues to move higher, those small cap oil and gas names that are on the Russell will continue to make better profits, and therefore those stocks will continue higher as a result. Once again, sector rotation is very evident. Strength as well, reading from left to right. Week after week, we've seen a change from reds, oranges, more yellows and greens, a little bit of red 3 weeks ago, more greens now, and strength in oil and gas continues to perpetuate. As long as this continues, we could see the S&P 500 and the NASDAQ move higher. Watch for tech, healthcare, oil and gas, consumer discretionary to continue to lead. And previous weeks, we can see a trend that continues to perpetuate in oil and gas, computer software, medical products, healthcare, transportation and shipping, oil and gas machinery and equipment, and of course retail, apparel, and shoes. So focus on these 6 groups going forward this week, and most likely the strength will continue to affect your portfolio and the stocks that you choose therein. Oil and gas, you can see the names that are ranked in this group. The big cap software enterprise group, the medical products group ranked by market cap. Some of the names in this group you might want to check out as well. transportation and shipping, oil and gas machinery and equipment, ranked by market cap, and of course retail apparel, shoes, and accessories. So that would include clothing as well. Consumer discretionary has been doing very well, moving up the list. But we'll be looking at some of those names in those top 6 industry groups for potential trades going forward. Okay, traders, that's going to do it for me. This is Cousin Vinny coming to you from theclosingprint.com with your weekend video newsletter. Look for a watch list later tonight, as well as some stocks that we're thinking of trading prior to the opening bell on Monday. Get outside, enjoy what's left of your weekend. Have a great day. We'll talk to you soon. Take care.